There are thousands of options across stocks, bonds, mutual funds, ETFs, and everything else out there. Today I'm going to focus on mutual funds and ETFs, explain how they're alike and how they're different. My name is Nathan Haskins, and I'm one of the owners of Free State Advisors, which is a financial planning and wealth management firm in Overland Park, Kansas. Investors have a lot of options when it comes to putting their money to work. You can become an owner of a company by buying a stock, also known as an equity, or you can lend a company money or a government money by buying their bonds. One of the things that is challenging, though, about buying stocks and bonds directly is portfolio diversification. Diversification means that you should hold multiple positions so that if one company hits a bump in the road, that your portfolio doesn't get really adversely affected by that one. It can be expensive to diversify, though. You should hold at least 25 positions to really diversify the individual company or the individual bond risk out of your portfolio. And to buy 25 different positions of even just one share apiece can get expensive. Mutual funds were created in the 1920s and further regulated in the 1930s and 40s to make it easier for investors to diversify their portfolio. Every share of a mutual fund holds a basket of different stocks or bonds or both, so that the holding is a diversified portfolio and you don't have to go out and buy 25 or more different holdings of individual stocks and bonds. Mutual funds continue to thrive today, offering investors a lot of different investment options for specific asset classes, and many funds are actively managed by professional portfolio managers. Now, the downside of using a fund is that there's an expense built in to pay for that portfolio management. That said, part of the fund selection is measuring its after-expense performance against a benchmark, which is generally an index of those same stocks and bonds that you're comparing against without any expenses built in. That gives you a fair comparison of how well that active management is performing. ETF is short for an exchange-traded fund. Very similar to a mutual fund, each share creates ownership of a basket of stocks, bonds, or other assets. ETFs are strictly regulated and subject to reporting requirements, also much like mutual funds. Mutual funds and ETFs are similar in being widely available, very liquid, diversified investment vehicles that can generate return by passing through distributions either from their underlying holdings and by price changes for each share. Both types of funds can be managed passively by being tied to an index, which is usually a low-cost option, or actively, which usually increases management expenses. There are a few key differences, though. First, mutual funds trade overnight, with the price determined by the net asset value of the basket of holdings in the fund. And when those assets within the fund are traded, capital gains can be passed along to investors along with dividend income. ETFs, on the other hand, are traded during the day in the open market, with buyers and sellers agreeing to a price which can be different than the net asset value of the holdings of the fund. It's unusual for the price to stray very far from the NAV, but some variance is normal. This can reduce transaction fees and allows investors to lock in a price right away to trade their shares during the day instead of waiting for overnight settlement. Further, capital gains for transactions within the fund are not passed through to investors, which in some cases can make the ETF more tax efficient. Now, ETFs, like other equities, have been subject to two-day settlement in the past, which has been slightly unfavorable to the overnight settlement of mutual funds. But that's changing. You may have heard of T+1, and essentially what that means is the industry is becoming more modern and trades of equities will settle overnight now, which is a really good upgrade for ETFs because it brings it more into alignment with mutual fund settlement and allows the sale of a security to turn into cash that you can take as a distribution even sooner. There are a lot of factors to help understand all the nuances of different investment assets, but I hope this has been helpful to explain a little bit more how mutual funds and ETFs are alike and how they're different. Both are fantastic ways to build a diverse portfolio. I hope this has been helpful for you, but please don't hesitate to reach out if you'd like to discuss further. Thank you.